A $25 billion Treasury auction just flopped. Foreign demand dropped sharply to 58.9%. Yields jumped, and international investors are now pulling back from U.S. debt. At the same time, Trump unexpectedly cut tariffs on Chinese goods from 145% down to 80%. No agreement, no trade talks, just a sudden policy shift quietly handed to Basant under pressure from the markets. Inflation is rising, the bond market is flashing warning signs, and Washington is making moves that even its allies can't fully grasp. So here's the big question. If the world isn't buying what America is offering, what comes next? Why did the U.S. end up paying more to borrow, with fewer buyers showing up? On May 9th, the Treasury's 30-year bond auction closed at a 4.82% yield, well above what traders had expected. Bloomberg reported that foreign interest, tracked as indirect bids, fell to just 58.9%, a major drop from the 6-month average of 64.1%. That signals growing uncertainty among overseas investors. The Wall Street Journal noted that primary dealers had to take on a larger-than-usual share, hinting that even close partners like Japan are hesitating. In fact, Japan sold off $36.6 billion in U.S. Treasuries back in March alone. Have you subscribed yet? You won't want to miss our next upload, thank you, and let's continue. This didn't happen in a vacuum. The auction followed Trump's move to double down on the 145% tariffs on Chinese imports, sparking fresh concerns about sticky inflation and possible retaliation affecting supply chains. As bond yields rise, so does the cost of managing America's record-high $34.6 trillion national debt, already expected to generate more than $1 trillion in interest payments by 2025, according to the CBO. But this wasn't just a weak auction. It was a clear warning sign. The global market might be pulling back from funding Washington's economic battles. Just 3 days after the auction troubles, Trump posted a new tariff number 80% on Chinese imports, down from 145%. But this wasn't the result of a new deal. It was an unannounced change on social media, quickly followed by a vague remark, "It's up to Scott B." That single line effectively handed off a $1 trillion shift in trade strategy to Treasury Secretary Scott Bessent, without any formal discussion or policy rollout. Reuters reported that this sudden turn caught not just investors off guard, but even Trump's own trade advisors. Meanwhile, China's Vice Foreign Minister Hua Chunying responded with calm indifference. Beijing, she said, remains confident in dealing with U.S. pressure. No matching move, no new tariffs, just silence. Dan Wang of the Eurasia Group told the BBC that the real message wasn't about adjusting tariffs. It was about economic stress inside the White House. If that's the case, the new 80% rate isn't a compromise. It's a quiet step back, disguised as policy. And it leaves one huge question hanging. If Trump's trade strategy is working, why is he the one backing down? April trade data from China's customs agency shows a contradiction that Washington hasn't resolved. While exports to the United States fell 21.2% year over year, China's total exports actually rose 8.1%. Beating forecasts and bringing in a record $96 billion trade surplus. Bloomberg Economics reported that the increase came from a 23% rise in exports to Southeast Asia and an 8% jump to the European Union. The takeaway? China isn't just avoiding tariffs, it's growing its market reach elsewhere. Experts highlight a structural shift where Chinese companies reroute products through third countries or pivot entirely to non-U.S. markets. Eswar Prasad, former head of the IMF's China division, explained that this adaptability is weakening the entire logic behind American sanctions. That flexibility is turning into industrial strength. Now, the uncomfortable question facing U.S. trade leaders isn't whether the sanctions are hurting China, it's whether they're hurting America more. U.S. officials keep promoting reshoring as the solution to reduce dependency on foreign suppliers. But customs data reveals it's largely an illusion. In the first quarter of 2025, Vietnam imported $30.2 billion worth of goods from China, a 26% increase compared to the same period last year. At the same time, Vietnam's exports to the U.S. surged, sparking concerns about transshipment, a tactic where Chinese-made goods are relabeled in third countries to avoid tariffs. The Peterson Institute estimates that up to 40% of Southeast Asia's exports to the U.S. may involve this indirect trade. And that's just the story of physical products. The situation with critical materials is even more troubling. China cut exports of gallium and germanium by 16%, reducing global supply and pushing up costs for industries ranging from electric vehicle batteries to missile systems. The U.S. still relies heavily on China for rare earths. Over 80% of its supply comes from China, according to the U.S. Geological Survey. But this dependency is now funneled through more expensive and unpredictable channels. The harder Washington tries to reduce reliance, the more it finds itself tangled in hidden supply chains. On May 8th, during a tense House Financial Services Committee hearing, Treasury Secretary Scott Bessent was asked directly, who actually pays the tariffs? His answer was, it's complicated, but markets don't tolerate uncertainty. This moment, clipped and broadcast by CNBC, caused a major shock to financial markets. FactSet data shows the VIX Volatility Index jumped 7.4% over the next 36 hours. Meanwhile, the S&P 500 erased its earlier gains and closed down 1.6%, a surprising drop on tariff news that many expected would trigger a rally. The bond market, already weak due to poor auction demand, added risk premiums, pushing the 10-year Treasury yield up to 4.39%, its highest since November. Analysts like Stephen Olson, a former U.S. trade negotiator, say Bessent's failure to clearly explain how tariffs work deepens global doubts about U.S. trade policy coherence. The impact isn't hypothetical. Investor confidence is falling in real time, not from ideology, but because the official in charge can't explain the policy's financial logic. The debt market is losing patience and no longer giving Washington the benefit of the doubt. In April 2025, China cut global rare earth exports by 16%, shipping just 4,812 metric tons, according to official customs figures, the lowest monthly total since 2019. The reductions targeted gallium, germanium, and antimony, minerals that the U.S. Geological Survey confirms are vital for semiconductor manufacturing, electric vehicles, and missile guidance systems. Bloomberg reported that China's Commerce Ministry tightened export controls on these materials, citing national security concerns. U.S. manufacturers who rely on neodymium magnets for EV motors are now paying 28% more per kilogram than they did 6 months ago. The Department of Defense acknowledged in April that 83% of its strategic mineral imports come from China or Chinese-controlled sources in Africa. Treasury Secretary Bessent faces pressure in Geneva to negotiate relief on rare earths as part of tariff de-escalation talks. But Beijing insists that any easing depends on full rollback of tariffs. So the U.S. is entering talks seeking critical materials while still enforcing 145% import duties. How will that deal close? On May 7th, former President Trump surprised markets by proposing to reduce tariffs on Chinese imports to 80%, down from 145% just weeks earlier, but gave no diplomatic explanation. The announcement shifted responsibility to Bessent. This move came after 3 weeks of weak bond auctions and a Reuters report showing U.S. retailers' freight costs jumped 22% in April as companies scrambled to replace disrupted Chinese supplies. However, China's Ministry of Commerce did not respond in kind. Instead, they restated their stance that any talks must start with the U.S. fully removing its tariffs. Eswar Prasad, former IMF China director, told Bloomberg TV that a one-sided tariff cut without reciprocity sends a clear signal. Washington's moves are driven more by inflation concerns than geopolitical strategy. Inside Geneva, Scott Bessent now faces a tough contradiction. It seems his side is negotiating with itself while Beijing waits for a stronger offer. If this is just a bluff, it's a costly one. Trump's May 6th announcement of a new trade deal with the UK grabbed headlines, but the numbers tell a different story. It looks more like a photo op than a real breakthrough. The U.S. Trade Representative reports that the UK accounts for only 2.9% of U.S. trade volume. While the deal allows tariff-free Rolls-Royce engines and more beef exports, it also raises the average tariff on British goods from 3.4% to 10%. The agreement does open $5 billion in new U.S. agricultural exports, according to Commerce Secretary Howard Lutnick, and British Airways announced a $10 billion Boeing order. Yet these wins are offset by tariff increases looming for over 90 countries, including China. Stephen Olson, a former U.S. trade negotiator, told Reuters, "This deal works with allies but doesn't apply to adversaries with leverage. Calling this a model for China is not just premature, it's fundamentally flawed." Howard Lutnick offered a rare glimpse behind the scenes, saying the administration might settle on tariffs with China around 34%, describing it as a human level that allows business to continue. That number is significant. Trump first proposed it during his 2019 tariff campaign, which the Tax Foundation estimated could reduce U.S. GDP by 0.8% to 8% annually if kept long-term. Compared to today's 145% tariffs, 34% seems moderate, but still quadruples pre-trade war levels. The Peterson Institute warns that even a 34% tariff on key goods could add 1.3% to core inflation and slash global trade by $430 billion each year. More importantly, it wouldn't stop companies from bypassing tariffs through Southeast Asia, where Chinese parts are re-exported to the U.S. with little oversight. So the real question isn't if 34% is politically possible, it's if it makes economic sense in a supply chain world that ignores borders. Scott Bessant came to Geneva demanding mineral access while defending tariffs that block supply. China entered selling goods at a record surplus, despite sanctions and without asking for relief. Now, the U.S. is caught between two growing crises, a bond market nearing collapse and a trade war strategy showing clear weaknesses. The 80% tariff is still unofficial. The 34% compromise isn't guaranteed. Meanwhile, debt auctions and inflation won't wait. Here's the real cliffhanger. What if China doesn't back down again? And what if buyers stop buying U.S. debt this time? Thanks for watching. Please like and subscribe, and check out another video now on your screen. Stay tuned for more hot news from 3 Daily News. Catch you in the next one.